Good morning. These are the things that matter most in Europe's market today. Hormuz risk is back in the tape. Brent is above $90. Long bond yields are pressuring duration assets. And AI is still powerful, but more selective. The central question is simple. Can Europe keep a constructive equity tone if energy becomes a tax on margins while AI spending still rewards only the companies that can prove revenue, orders, and cash flow? Start with Iran and oil. CNBC reported that a ship was attacked in the Hormuz Strait as the U.S. Iran ceasefire expiry risks a prolonged conflict, and investing.com flagged oil gains as bond yields rose. The Yahoo snapshot has Brent around $91 and U.S. crude near 85. That is not just a commodity price. It is a transmission channel into European margins. For Europe, the cleaner side is Shell, Total Energies, and BP, where stronger crude can support cash flow and energy security exposure. Pressure sits with fuel-sensitive names such as IAG, Lufthansa, and Ryanair, and with chemical or transport companies that cannot pass higher input costs through quickly. For private investors, the filter is not oil up or oil down. It is who pays for the energy shock. If crude stays firm while the VIX also lifts from very low levels, does the market reward energy cash flow, or does oil become a tax on airlines, chemicals, and consumers? Second, mobility is becoming an AI deployment story. CNBC highlighted Japanese car companies as vulnerable to a 1-2 punch from Iran war energy risk and a yen rally, while China technology and electric vehicle competition remain hard for global companies to ignore. For European investors, this turns mobility into a pricing power and software test. Winners are not simply all car companies. The cleaner side is companies with defensible electrical systems, premium software, industrial automation, and brand strength. Pressure sits with Volkswagen, BMW, Stellantis, and Mercedes-Benz if Chinese EV pricing, battery technology, or software-defined vehicles keep compressing the margin map. For private investors, the practical takeaway is this. China exposure is not one basket. It can be demand support, supply chain proof, or direct margin pressure. The useful watch is whether premium pricing and supplier orders hold up while cheaper technology keeps improving. Third, Chinese technology is becoming harder to separate from the global AI story. CNBC's China Connection framed the race as money versus power and also reported Alibaba's answer to Meta with a new laptop-ready model. Investing.com noted Google's plan to end pixel production in China in 2027. The hidden mechanism is supply chain control. Who owns the tools, power, data, manufacturing routes, and software layer? The cleaner European side is ASML, Infineon, Schneider Electric, and Siemens when AI and reshoring demand becomes orders for equipment, power management, and automation. Pressure sits with companies whose China exposure is mostly competition, not a source of differentiated technology or margins. For private investors, the filter is proof. A strategic theme can be real and still not be investable today unless orders, margins, and cash flow confirm it. Fourth, the AI financing chain is still alive. CNBC reported Nvidia backing $105 billion of financing for an OpenAI data center in Ohio, and Anthropic telling investors that its annualized revenue run rate climbed to $65 billion in July. MarketWatch also noted strength in Micron, SanDisk, and other memory chip stocks as confidence in AI spending improves. The beneficiaries are the picks and shovels companies where AI spending can become measurable demand: ASML, Infineon, Schneider Electric, Siemens, and SAP. The pressure side is AI labels without proof, crowded momentum trades, and companies carrying high capex without visible revenue conversion. For private investors, the takeaway is not to chase every AI headline. The question is whether the spending chain reaches European revenues, electrical infrastructure, chip equipment, and enterprise software. If not, the headline stays more American than European. Here is the stock-led watch list. Shell, Total Energies, and BP test whether oil is still cash flow support. IAG, Lufthansa, and Ryanair test whether fuel costs become a margin tax. Volkswagen, BMW, and Stellantis test whether the China technology story is priced as competition or as recovery. ASML, Infineon, and Schneider Electric test whether AI capex is reaching Europe. LVMH, Kering, and Mercedes-Benz test whether China demand and premium pricing remain stable. Market bias, selective, and supply shock sensitive. Europe can open calmly, but today's quality test is whether oil, Yields and AI proof all move in the same direction or split the index into winners and pressure. The mistake to avoid is treating calm index levels as confirmation. Company-level proof matters more than the headline tape, especially when energy, rates, and AI financing are pulling on different parts of the market. That is the Europe Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.